So the production tax credit, just like is in the name, will incentivize and will reward actual production. What that means then is if you're located in a location, a lot of parts of California, for example, where you have a very high load factor, you're producing very frequently with that solar project, that starts to become more attractive. If you're located in a geography where you're already not producing a lot, right, maybe not the most sunny parts of the country and parts of PJM, it's kind of a double whammy where you're already not producing a lot and you're then getting less incentives on those times when you are producing.
Hello and welcome to Energy Unplugged by Aurora. This podcast features various experts from Aurora having in-depth conversations with key industry leaders, policymakers and academics from all over the world. It explores the hottest topics across the energy market and gives a unique perspective on major energy issues.
Hello and welcome to Energy Unplugged. I am Oliver Kerr, head of Aurora's US business, and today we have a special all-Aurora episode for you on the Inflation Reduction Act. The IRA has been widely hailed as the most significant piece of climate legislation in the US in over a decade. I think it's fair to say that it will go a long way towards accelerating the energy transition. At the same time, there is a whole lot of nuance and complexity underlying that largely positive headline message. So questions like how quickly can wind and solar scale given real-world constraints around supply chain and interconnection issues? What determines whether solar will take the production tax credit or the investment tax credit? What impact will that have on power prices? How will REC prices respond? How will new battery entry enter ancillary service markets? What's the impact on new build versus existing assets? And how does all of this vary across markets, which are all quite unique across the US? So to help us answer some of these questions, we have three excellent guests all joining here in the Austin, Texas studio. We have Martin Anderson, who is head of our research team in the US. We have Felix Chow-Kambitsch, who is head of our Western US region. And we have Julia Huss, who is head of our Eastern US region. So we've got full coverage here on the line today. So Martin, I think let's start with you. And before we get into some of the detail on the IRA, I think I wanted to start with a more general question around the state of climate policy and the energy transition more broadly in the US, especially for some of our listeners who are listening, perhaps not from the US. You spent a good chunk of your career in Europe. What are some of the key differences you've noticed in the way the US approaches energy and climate policy that you'd highlight for our listeners, perhaps on the other side of the Atlantic?
There's definitely been a lot of differences with regards to Europe versus the US, but there have been some similarities as well with how the countries have contributed towards this. If you look at the US as a whole, it is a federal system, and you do have 50 states, both with their different policies, but you still have federal policy as well within the US. And you see similarities in a way with how Europe has been growing around that as well. Europe, historically, a lot of the decarbonization efforts have been led by individual countries. If you look at Germany and Denmark, both of those countries were pioneers with regards to deploying new wind, and a large number of companies have been built out of those countries as well. The UK was a pioneer in offshore wind and went through the fastest deployment of new offshore wind of any country in the world. And we've still seen that across countries as well. It's always surprising to me looking at the UK and seeing that Texas, despite all of the sunshine that we see across Texas, still comes out with less installed solar capacity than in the UK. So interesting to see those differences there. I think with regards to the changes that we're seeing now, obviously the US pushing ahead a lot more of federal ambitions. So far across the US, there have been some pioneering states, California in particular. If you look at the CAISO market, they have around 40% of their generation coming from renewable sources. If you look at the European-wide estimate, that's around 25%. So if you compare just California to the average of Europe, California is actually quite pioneering in that sense. However, it does, of course, vary. There are some countries which are a lot more ambitious and are already at a much higher level. But in general, you do see that broad differences between both European countries and across US states as well.
Another thing that just strikes me in general is the difference between sort of competitive and uncompetitive markets. I think that's one thing that I've been surprised about in the US as a whole, that 40% of power is still sold in basically regulated monopolies, very different to many European markets. Another thing is just the role of tax credits in general, especially at the federal level. So much of energy policy is driven by, tax credit incentives as opposed to some of the, just a much wider array of mechanisms and subsidies that we've seen in somewhere like Europe. I mean, Julia, just reflecting on, are there broader political reasons in the US why that's the case?
That's right, Oliver. I would say largely the topic of a subsidy can be quite politically sensitive in the United States. And I would say that's been one of the biggest differences that I've noticed in comparing the two markets. In Europe, there's quite a few ways that the business case for renewables can be helped directly, either through direct subsidies or things like CFDs. In the United States, there's been a lot more pushback to that. And what we tend to see is that when legislation is passed to support a political agenda like that, it has to be written into the tax code within the United States, meaning it has to go through a different legislative process to make that kind of agreeable with our largely contentious Senate at this point. I think the other thing, too, probably worth highlighting is just the type of conversation we're even having in the United States when we say energy transition. I was fairly surprised, I would say, visiting the UK recently and hearing the conversation that folks were having where energy transition no longer even means wind and solar. It's far beyond that. Those things are taken for granted, right? And it's largely a conversation around hydrogen and new technologies. In the United States, when we say energy transition, we still very much mean those traditional renewables and starting to bring those to a point of a larger percentage of our generation.
The point around hydrogen is definitely something we'll come back to that might be changing with the IRA, but let's put a pin in that for now. But Felix, without getting into some of the nitty gritty, just turning to the IRA, can you give us the lowdown for some of the main provisions and what they mean for the power sector?
Thanks, Oliver. You're right. I probably won't go into a whole lot of detail because the IRA has been out for about 4 months now, and there's plenty of commentators looking at the nitty gritty. But in terms of the big messages, I'd say there are 2 things I like to focus on. First is the scale of the energy and climate change spending coming out of the IRA. And then the second is the certainty of the incentives. So in terms of scale, like the headline figures are already big, right? The headline figures are, $369 billion of energy and climate change provisions. Those are big numbers. But actually, a lot of the tax credits are uncapped. So potentially the actual money spent through the tax credits could be much more. I mean, there's some commentators out there estimating something like $700 or $800 billion in total. So the actual sums of money is huge. And then when you look at the project economics itself, the value of the ITCs, they start at about 30% for an ITC, but you can add various adders to it. And with domestic content, with energy community, with low income community criteria, adding all those layers on top, you can get something like as much as 60% ITCs. And there's a similar adder to the PTCs. So for project economics, we're talking about material shifts in the ability to monetize these tax credits. And then the point on certainty, I think up till now, ITCs and PTCs have been on a sort of ongoing need for renewal. With the IRA, now we have a certainty of 10-year horizon. So projects starting up to as far as 2032 will have the certainty of access to these tax credits. And what that means is it really gives developers, it gives investors, it gives banks the ability to plan long-term and orient their businesses around projects that are getting access to these tax credits.
Really interesting point around the different components for the ITC and PTC. I think that's going to result in a lot more variability across projects. So far, when looking at projects, you've been looking at capex cost and capacity factors. Now, with these different components of the ITC and PTC as well, you're going to see a bigger range in terms of project returns. So fascinating the impact this will have on overall project variability.
Just on that point, Felix, you mentioned some pretty eye-watering numbers there, up to 60% for the battery tax credit. You've been working with sponsors and project developers. How much do folks expect to actually be able to monetize of that for any given project?
Good question, Oliver. I'd say the 60% is definitely a maximum theoretical of which most projects won't be able to achieve the full 60%. And that's, firstly, I think that's to do with how many of the adders you can realistically have. Domestic content is potentially quite hard for some technologies like battery storage, where a lot of cells are made internationally. adders on energy community is perhaps the one that's easier to achieve. And then also low income really depends on what state you're looking at. So from our assessment, most projects will try to have one or two of those adders. What that means with the ITCs, we're talking about instead of the minimum 30, projects are aiming to get about 40%, or in some cases 50% of the ITC. And that's just the tax credit itself. There's also, you have to think about the pass-through rate of that tax credit to the developer. There's transactions costs. You need to be able to sell that tax equity to an investor. And through that process, we estimate about 90% of that value is retained for the developer. And then there's also knock-on effects of the rest of the supply chain. So the developer, may see this extra tax credit value, but then throughout the supply chain, because there's a lot of bottlenecks throughout, such as land rents, connection costs, all those elements of supply chain, we're expecting to increase slightly to capture some of that value.
Before we dive into some of the technology specific detail, like Martin, across markets, US wide, what do we expect as some of the big picture implications of the IRA? Perhaps you could start with emissions. I mean, is this going to get us to net zero?
So at a high level, the impact this is going to have on carbon emissions, undoubtedly it's going to reduce carbon emissions. It remains to be seen whether it's going to get us to net zero, I think, especially by the current target that Biden set for net zero in the power system by 2030. I think undoubtedly there will be more renewables deployed. By giving these extra tax credits that Felix has outlined, this is going to encourage more to come through. There remain a number of challenges as to why you can't just get to net zero. I think one of the big ones is how quickly renewables can be built. We're going to see across markets a number of challenges. One of those is going to be around interconnection queues. We're already seeing that in PJM, and a number of challenges around getting these projects actually deployed at the moment. And if you look at how many projects are still in the queue and trying to come through, there's going to be a challenge as to really scaling that up. I think another of the challenges is going to be a transmission and scaling up that at a high level as well. Already the transmission across the US is aging, and just keeping the transmission as it is going to remain a challenge. And so to incorporate these larger amounts of renewables is going to take a lot more investment as well. If you also look at the challenges we're seeing across supply chains across the world as well, that's highlighting that these challenges are going to continue into the future as well. We've gotten used to across the market, across declining wind and solar costs. That's not to say that there aren't going to continue to be improvements across the technologies and across how we're using natural resources, but to scale up and to assume that the costs are going to keep falling is uncertain at this stage. In terms of carbon emissions as well, I think one of the big challenges is also going to be ensuring security of supply across the system. Wind and solar can go a long way, but you can't run a power system solely on wind and solar. Fossil fuels are still going to play a role into the next 10, 20 years in order to ensure security of supply. We're seeing that carbon capture and hydrogen can be getting additional support from this, but it's uncertain whether those are going to be sufficient alongside renewables and alongside battery storage to provide 100% of the power generation. So getting to net zero, definitely a number of challenges still remain, and it's uncertain whether we can fully scale up at this stage.
To get a bit more concrete on some of those points, I don't know, Julia, Felix, you've both been spending significant amount of time on PJM and the Northeast and California and the WECC respectively. Martin mentioned some of the challenges there. Are you seeing this play out on the ground, or are you seeing a slightly different picture?
Thanks, Oliver. I would say the headline here really is that with the Inflation Reduction Act, the business case starts to work out for renewables in a lot of different geographies. But just like Martin has been mentioning, there's two big factors that interplay there that we have to take into account when we look at the actual ability to deploy renewables on the ground. The first factor that Martin had already teased here is that we have some issues across the country in a couple different places to actually bring renewables online. And I think PJM builds a really nice case study here where we have across states and geographies in the United States, in order to bring new capacity online, projects need to join the interconnection queue to be studied and in order to actually be brought online. And even prior to the Inflation Reduction Act, PJM had major issues with bringing projects online. The queue was incredibly bloated. It was being used as a speculative tool for projects that never really had the intention to bring to fruition, but rather just to study or to maybe hold a place in line. That got so extreme that this year PJM announced a complete hold on the interconnection queue and bringing online any new projects. And the ISO is now working through kind of a slow and painful process to start to get through some of that backlog to bring projects online. What does that mean tactically? It means projects that were already in the queue are moving through kind of a what's called a fast lane process in 2025 through 2026. Of course, I think anybody that's looking at the IRA and saying, now's my chance to invest, 2025, 2026 doesn't seem particularly fast, right? And projects that weren't in the queue yet, they're taking even a couple of more years to bring online. And that exactly interplays with the points that Martin made earlier, where even though that case is there, you have to actually look at the fact that a lot of those projects aren't coming online in the next couple of years. I think the other really important local dynamic to bring into the conversation, again, touching on this point of a federal system, is that states have been setting their own ambitions for renewables and decarbonization for the last couple of years. So in PJM and in a lot of different states, that's active through what's called Renewable Portfolio Standards, or RPS, which is a percentage of load that is anticipated or that's required by law to come from renewables or zero emission technologies. And as I touched on earlier, most of incentivization towards decarbonization in the United States happens through financial incentives in order to make the business case more attractive. So that's what's been happening in a number of states in the US already, that those RPS are supported by RECs, or renewable energy certificates, which is an additional revenue stream for developers to bring online their wind and solar projects. What does that mean for the IRA? It means that within those states, there's actually already a system in place to improve the economics and the revenues for those projects within those states in order to meet those decarbonization targets. So if you look at a state like New Jersey or Maryland, they already have a system in place. Their target is 50% renewables generation by 2030, and there is enough money within those state systems through those RECs to get the system to that place by 2030. The IRA provides some additional financing, but what it does is essentially it starts to displace some of those systems and doesn't necessarily provide enough additional financing that you would, for example, outshoot or outperform some of those state level goals.
It's actually quite interesting, Julia, to hear about the dynamics happening in PJM, because in California, there's similar dynamics happening for almost different reasons, but you end up with a similar result. So in California, in CAISO, we already have a lot of solar and storage being economic to come in even before the IRA. So really the limiting factor on new development, new solar projects, new battery projects was not really in the economic side of things, but in, as Martin mentioned earlier, in the interconnection queue, in supply chain bottlenecks. So there are already a lot of interest in building new assets, and the IRA can only do so much to help, because ultimately the bottlenecks are coming through these other features. So what we're seeing is with the IRA, it does improve project economics. It does, in the longer run, help with further deployment. But because of those short-term interconnection problems and bottlenecks on the supply chain, we're not expecting a whole lot of increase incrementally because of the IRA in terms of new projects.
Yeah, really interesting, Felix, around California and the impact that the IRA is having. Within Texas, I think from the modeling that we've done across the ERCOT market, we see a bigger increase from the impact of the IRA. These step ups in the tax credits that renewables projects are able to get mean that a lot more projects become viable. And therefore, we're seeing a step up in terms of the wind and solar capacity that's being deployed across Texas. Texas does have the renewables portfolio standard, but it met that target back in 2015, where there was already a lot of wind capacity installed at that time. So therefore, the additional tax credit support is purely going straight through into developers' pockets as additional support and bringing new amounts of capacity through. So by 2040, we're expecting to see around a 50 gigawatt increase in terms of the wind and solar capacity being deployed across ERCOT.
Wow, 50 gigawatts is a pretty spectacular number. Maybe to get into some of the nitty gritty on project economics, then, I think one of the questions that we face most often these days from project developers is, what do tax credits mean for me? To take a concrete example, if I'm a solar developer, I now have a choice to take the production tax credit or the investment tax credit. A question to the group, really, which one should they take?
It's a great point, Oliver. Actually, one of the biggest takeaways for me from the IRA and the new tax credits that are coming through is that as a project developer, you really have a lot more customized options now than you did before, with the opening up of additional funding based on some of those provisions that Felix was mentioning before, and like you just mentioned, the choice. So solar has always had a choice for the ITC, for the investment tax credit, and has now also had the door opened to applying that PTC. What it means is that at a project specific level, you're really making a trade-off with which of those is more valuable to you. So the production tax credit, just like is in the name, will incentivize and will reward actual production. What that means then is if you're located in a location, a lot of parts of California, for example, where you have a very high load factor, you're producing very frequently with that solar project, that starts to become more attractive. If you're located in a geography where you're already not producing a lot, right, maybe not the most sunny parts of the country and parts of PJM, it's kind of a double whammy where you're already not producing a lot, and you're then getting less incentives on those times when you are producing. On the other side, though, you have that investment tax credit that's available, which helps to ease some of those upfront investments on the CapEx. So that becomes a calculation then whether the investment tax credit can ease some of that upfront investment in terms of the CapEx. And of course, right now, all eyes are on CapEx in the United States. We've been seeing a steady decline over the last couple of years in terms of the costs to bring online some of those projects. But within the last year, like Martin touched on earlier, has been one of the first times. A lot of folks aren't as optimistic about that upfront CapEx coming down, caused by some of those supply chain issues, for example. So if we see that continue to be the case, that CapEx costs stay high, it actually continues to remain attractive to get that upfront tax credit. And just to apply some numbers to that, we've run some sensitivities on this analysis, and the tipping point really that we've come up with is that if you're looking at CapEx below $1,000 per kilowatt for your solar project, the 28% starts to become the tipping factor for capacity factor, where you would start to favor that investment tax credit.
So I suppose my crude layman summary to that is, in sunny places, if you have low CapEx, you want to take the production tax credit. If you're in a less sunny place or your CapEx is especially high, you probably want to take the investment tax credit.
That's exactly right. Very much more eloquently summarized than I put it together.
We spent quite a lot of time talking about wind and solar. Another key technology that is significantly impacted by the IRA is batteries. Felix, Martin, you've both been working on a ton of battery projects over the last 6 months. How are project developers thinking about the implications for the IRA on battery deployment?
So firstly, for one, the IRA introduces ITC tax credits to standalone batteries, which previously didn't exist. Previously, for a battery to get an ITC, you needed to be co-located with solar, whereby the energy is taken from solar and rather than from the grid. So this is actually a big change that enables standalone solar. That being said, currently we're expecting some relatively rapid increases in battery CapEx. The numbers that we're getting, we're seeing about sort of 30%, 40% increases in CapEx relative to last year, relative to the year before, in really to do with the supply chain disruptions we're getting and the really high demand on batteries across the board. So in a way, the tax credit introduction is a welcoming relief to counteract some of those temporary supply chain issues that increases CapEx. And then you have to think about what happens when you have more batteries on the system. And that's where Aurora's modeling, we need to figure out the implication of having more batteries on the market and what that means to various prices in the ancillaries markets, as well as the power price themselves. So looking through at the effects of adding more batteries onto ancillaries, we're expecting that the overall implication of the ITC is, with 30% ITC, you can still improve the IRRs for batteries about 7% on net, but you do need to take into account those knock-on effects on the market prices.
And across the ERCOT market as well, it's a similar impact that we're seeing. The ITC is a huge game changer in terms of the tax credits opening up to standalone storage. The fundamentals for storage were still improving as well. I think if you look at the fundamental revenue streams, as Felix mentioned, the ancillary services and the wholesale market, And in KAISO, obviously, you have the resource adequacy piece as well. In ERCOT, you don't have that, but you do have scarcity, which impacts both the wholesale spreads you can make and also feeds into the ancillary service prices. I think both of those streams were good revenue sources for battery storage. And by applying this ITC, essentially, it brings down the revenue that you're needing from this. So whilst more batteries will be coming through into the system, the break-even point that you need to be making money from ancillaries and from wholesale is going down as well. At the moment, the main play from batteries in ERCOT is through ancillary services. So that's the majority of their revenue source. We'd already expected that to change over time as you have more batteries coming through, you're having to share that out across a larger number of batteries. And increasingly, the revenue that comes from batteries is from wholesale arbitrage. By introducing the ITC, that doesn't change. It may speed things up a bit at the point at which you're shifting over to wholesale arbitrage and may reduce the spread that you need as well. We often think about the average daily spread or the TB1, TB2, depending on your battery duration. That can lower. If you have a lower ITC, you have less CapEx costs and you're reducing the spread that you need to break even for your battery investment case. So overall, expecting this is going to increase the amount of battery capacity and reduce the gross margins that you need coming through as well.
And while we're talking about ancillary services prices, I think one thing to note is it's really important to understand the increase in supply on these markets. These tend to be relatively small markets. So what that means is, yes, as you increase the amount of batteries on the system, the price will be a bit down. However, the price will never be zero because there's absolutely a cost in providing the service. So when you're producing, let's say, providing a regulation service, you are using the battery throughput and you're expending a bit of your cycling. So the value of that cycle that you've used creates a floor in the value of these ancillary services. So we do a lot of thinking around what is the longer term trend on these ancillary services, and in certainly contrast with some views out there that sort of take recent history and project those numbers in the future. You really need to look at the fundamental shifts in supply and demand.
And I think that point is very relevant for just understanding how these incentives play out within the broader system. Like Martin, you mentioned 50 gigawatts of additional solar in ERCOT. That leads to a pretty incredible solar evening ramp by the time you get to 2035, 2040. That in turn is driving a lot of value for flexible technology like batteries. And I think it's one of the reasons, at least, that ERCOT is in the midst of fairly extensive discussions around market reform needed to make sure some of those assets are there to help with system reliability going forward. One technology we haven't mentioned at all is hydrogen. There were some pretty generous tax credits in the IRA for hydrogen. Do you want to talk about the expected impact of that on the market?
There's been a huge amount of interest from our clients around hydrogen and the new policies that are coming through in the US. On the one hand, with the IRA, we're seeing greater amount of support in terms of tax credits for hydrogen coming through. We're now seeing that green hydrogen in particular is going to be eligible for a $3 per kilogram tax credit, which is massively going to improve the competitiveness of green hydrogen when compared to other sources as well. Blue hydrogen is also eligible for up to $1 per kilogram in terms of support for LCOH. And those 2 points combined are going to mean that green and blue hydrogen are going to be cheaper than grey hydrogen in terms of different manufacturing sources. So by 2025, estimating that green hydrogen is going to be the cheapest method of producing hydrogen. This is all going to have a massive impact in terms of the wider hydrogen economy. And it's worth noting as well, this is only one piece of the available support for hydrogen that's taking place at the moment as well. We'd already seen greater support for hydrogen in the Infrastructure Investment Act, which was passed in November 2021. Within that piece of legislation, there was around $9.5 billion available for funding hydrogen hubs. On top of that, the Defence Production Act, which was passed in June, also established the need to build green electrolyzers domestically as well. So really the Inflation Reduction Act and the tax credit support that's coming through is just one piece of the wider support that's going to be available for hydrogen. And in terms of where we see hydrogen developing, as I mentioned, there are those hydrogen hubs which are going to be taking place across industrial areas, a number of those looking across the PJM market and in terms of in Texas as well. Expecting that hydrogen is going to be used for industrial purposes. There's then the greater question around how hydrogen is used in the long term as well and the wider impact that has on the power market. If you look at the impact purely from green hydrogen electrolyzers, that could increase the demand for power. So that will have a knock-on impact and put upwards pressure on prices for power. At the same time, At the same time, there is potential for hydrogen to be used as a fuel source as well. Expect it's largely going to be used as a peaking technology and not as a baseload technology. But there is the potential there for hydrogen not just to impact the demand for power, but also potentially the supply as well going forwards.
Excellent. And before we finish, there's one area that we haven't touched on, which is the impact on other markets like renewable energy credits. Julia, I think in somewhere like PJM, RECs are a material part of project value. How does something like the IRA impact that market going forward?
That's exactly right. And we've made the point earlier that power markets are incredibly complex, where the price that happens in one part of the market is going to impact pricing in other part of the market, in particular, because generators are bidding in based on their costs elsewhere and their expected revenues in other parts of the market. So when we think about the interaction across different markets within our modeling, for example, we take into account the levelized cost of energy that Martin was commenting on before and the levelized revenue of energy that generators are expecting to see. In the case of RECs, for example, in PJM, that's an additional revenue stream that generators are depending on in order to make their business case profitable and in the long term for their renewables. When we think about the different revenue streams that a generator expects to have coming in, the IRA just adds an additional revenue stream when they're potentially selling off some of those tax credits or tax savings that they're expecting. And so what does that mean? There's really much less of a need to have this additional revenue stream come in from RECs. And so in turn, what we see is that REC prices actually start to go down. So positive overall for generators because they're more sure about their business case and they're needing to rely less on those RECs. That ends up being a positive for some of the utilities in those local regions as well. You know, those utilities are critical to implementing the renewables portfolio standards that states have set. So either they're paying for RECs or they're paying an alternative compliance payments. And in states where they're needing to purchase those RECs, we do see the costs go down overall for them as they're paying a lower amount for the RECs in those states.
Great. So just to tie things up, it sounds like headline message coming out of this overall is IRA, as could be expected, is a largely positive story across technologies, wind, solar, hydrogen, batteries. At the same time, you know, there are nuances at the local level. You do have to take things like interconnection queues, supply chains into account. Just before we wrap up, maybe any reflections finally on what is not included in the bill?
I think one key change that we've seen with the Inflation Reduction Act has been how it's pivoted from the earlier Build Back Better Act, which was floated beginning of this year and actually got sidelined and was actually looked like it might fail and not get passed at all. And then suddenly in July this year, the Inflation Reduction came through. I think a few of the provisions that were missing from that was around the grid resilience piece. So we've talked already that there's been some support in the Infrastructure Investment Act, which was passed last year, but there was expected to be additional amounts of grid resilience payments within the Build Back Better policy. So it was $9 billion that was going to be earmarked for grid resilience. That's been taken out. And I think there's been other aspects which have been taken out around the $13.5 billion for EV infrastructure, the $17.5 billion for decarbonising federal buildings. So a number of different aspects where you've seen that taken out. But I think the big one for me was on that point around the transmission support.
Transmission definitely being a key piece of the energy transition, especially considering the increased volumes of renewables we expect as a result of the IRA, and something we're seeing in a lot of the project work we're doing certainly right now. Excellent. I think that's a good note to finish on. Thanks so much for taking the time to talk about some of the major momentum that we're seeing in the US. Thank you, Julia.
Thanks very much, Oliver.
Thank you, Felix.
That's great. It's been a pleasure.
Thank you, Martin.
Thanks, Oliver. Great to chat.
And thank you all for listening.
That was Oliver Kerr, Aurora's head of US, talking to Martin Anderson, Aurora's head of research in the US, Felix Chow-Kambitsch, Aurora's head of US West, and Julia Hoos, Aurora's market lead for PJM. Do keep an eye on our podcast feed for more in-depth conversations with senior members of the energy industry. The best way to do this is to subscribe on whatever platform you use. Thanks for listening and goodbye.